Hey, everybody, welcome back. It has been a while. Let me just make sure that, yep, my recording is running here. Sometimes I make these recordings and I don't know if my sound is being recorded as well as the picture, and I have to start all over again. Really annoying. Okay, so I want to point out a couple of things here that I want to talk about today and some, I guess, difficulty. So, what you have here is a 15-year weekly chart of the S&P 500. And as you can see, it's extremely impressive as we try to drive here for new highs. Now, I just wanted to get to some perspective here because I want to share with you guys probably one of the most powerful indicators that you can use for predicting market corrections, or sometimes they're full blown crashes, and sometimes they're just corrections. Okay, and that tool is the ISM data. And a lot of people, they really don't really understand what the ISM data and why it's really important and why you should become an expert on it. So there's actually two types of ISM data. There's the Purchasing Managers Index, and there's also for manufacturing, and there's also the there's the non-manufacturing. You can see that, where the heck is it? Even Forex Factory underestimates it. They have it as a orange. So I want to go back and take a look at this. Okay. Now, so what we're going to do here is we're going to look at all these dips in both of these. In particular, we're going to focus on the manufacturing data. Now, a lot of people will say to you, well, Steve, manufacturing is not a big part of GDP anymore, and that's true. But what this actually does is it is a leading indicator for the entire GDP. So even though manufacturing and this data only represents somewhere in the neighborhood of 17% or 18% of GDP, it's still a leading indicator. Well, what do you mean, Steve? Well, the first thing you want to understand is anything above 50 is expansion, anything below 50 is contraction. Okay, and I first learned about this data way back in the early days. Back in the 2000s, when I actually started using this information, and it's been fairly accurate and fairly reliable. It's been around for a very long time, but a lot of people just really don't pay attention to it, and I want you to. So, as you can see right now, I'm a little bit bearish on the market. If you go to my floor traders room, you can see that I am still, by the way, I'm up 55.5% on the year. Even after last week, I was down with a 3.5% loss, and currently I just have one position, which is a short cat. So, looking at this manufacturing, and let's delve into it a little bit. First of all, let's look at the big obvious numbers here. So going back to 2000, does anybody remember what happened in 2000? The tech crash. Yeah, there it is right there, predicted by the manufacturing contracting underneath 50. Now, what you really want to pay attention to more than anything is the trend of this. Does anybody remember the bubble in 2008? Oh, there it is right there. Okay. Now, I want to assure you, you can go and test this for yourself. But this happened before both of those crashes happened. Anybody want to look at 2016? Well, let's look at some charts, shall we? So, dum dum dum. I don't have all the way back to 2000, but you know what that looks like. I mean, I guess I could get that. But here's the 2000. Here's the 2008 crash. Here's 2016. Okay. just go and watch how this will predict the market direction. Now, I want you to also understand something very important here. It's a leading indicator. Okay, it's probably one of the only leading indicators that you can find to predict market direction. However, you have to be very careful with it because it doesn't happen like on the day of, right? It can take anywhere from 1 month to 3 months. I've never really seen it take longer than 3 months to predict what the market's going to do. And go back for yourself, walk through a chart day by day, and just look what happens when manufacturing starts to contract. And more importantly, don't just look at isolation. Look at trends. That is really what you really want to follow, the trends of these things. Okay. Now, you also have to sort of marry it with the non-manufacturing because they go hand in hand at predicting GDP, but manufacturing is more of a leading indicator than non-manufacturing, and don't ask me why, but it is. So you kind of have to marry it with both of these, and you're just looking for general trends. As you can see, non-manufacturing has not been in contraction since 2010, right? So just bear that in mind, okay? So when you're looking at manufacturing, marry it with GDP and look at those situations where they both go negative, right? Now this month we did have a bit of a big spike here. On the non-manufacturing side, it came in better than expected, but the overall trend is still down. And that's really what you really got to pay attention to. Now, just so you know what a recession is, a recession technically is 3 months of contracting manufacturing data. That is what a recession is, okay? So, really important that you pay attention to it, you use it, you have it as a backdrop, and I want to repeat that. Really, really important that you use it as a backdrop, not as a decision maker, but really a backdrop. 49.1 is a really effing bad number. This saved it a little bit on Thursday when we came in at 56.4. Had we have come in at 52, I would say the market would be down probably a lot more than it is right now. Doesn't mean that the market you shouldn't still be bearish, because you should, because the trend is still down on this, but you're just going to have to pick your spots a little bit more carefully, okay? So, now that I've discussed that, to kind of give you guys a backdrop of how to use this information, and don't take my word for it, go and back test it for yourself, okay? Spend 90 hours, 100 hours walking through daily charts and comparing these things, and you're going to see something that will blow your mind, okay? Don't listen to the media about trade deals and jobs numbers. That's all dog shit compared to these two leading indicators. Those indicators are lagging, these are leading, okay? So that being said, I want to talk about, why am I only at 55.5% this year, and it's already August? Usually I can have almost 100% per year, but this year has been a really effing hard year, and it isn't even this year. It's actually been the last 2 years, and I want to talk about that right now. It's actually been 3 years now. So what I want to do is take a look at the last 3 years of on a daily chart. So this is since the election, okay? Now everybody's talking Trump talks, the market's higher because of me. And yeah, he's right, it is higher because of him. But what about before him? Let's go back to that weekly chart. So here's 2016. What about the 4 years before that, 2012? Do you notice a difference in the volatility change? Okay, so here's when we go back 8 years, really, if we take a look at since Obama was elected. And, here's my point. It has nothing to do with Obama or Trump. Okay, but I just like to set the record straight. Let's look at the Obama years from here to here. Fairly steady with moderate pullbacks into value. Nice, strong trend. Now, was it Obama? Hell no, it wasn't Obama. Okay, what it was the Fed and QE putting a safety net underneath the market and pumping massive amounts of liquidity into the market. However, let's also see how that translated onto the ISM data. So here we have the crash, and you can see what that did was that spurred growth in non-manufacturing, and that spurred really substantial growth in manufacturing, and then we kind of chopped around a little bit here, but we stayed above 50 for the most part, right? See these big, don't pay too much attention to big drops. You're looking for trends in this, okay? So what the Fed did was by flooding liquidity, it allowed both manufacturing companies and non-manufacturing companies to be able to go and borrow money, and that translated into this growth that we're seeing here on these charts. Okay? Now, I'm not going to debate whether I think it was good or bad. I think everybody knows I think it's a terrible thing, QE, and I think it's just an artificial bubble, because I think all of this is just artificial. And it all translates into nothing more than an average of about 2.5 or 3% GDP growth. Okay? It hasn't really stimulated anything. It's just kept status quo. Okay? Now, so that being said, I don't want to get off on a tangent on that. That being said, let's go back to look at the Trump years and why it's taken me so long to figure out how to trade these Trump years. This was easy. You just buy value, buy value, buy value, buy value. But now we've become a little bit harder. So let's just take a look at that. Now, even though we are a lot higher, notice how we are higher. Okay? You have a nice steady run up here, followed by boom, a big correction. Then it spikes back up, boom, back down. Then it slowly winds its way back up, and then boom, giant correction back down. And then a slow grind back up, slow grind back up, slow grind back up, boom, big correction back down. Now, this is effing hard to trade, because where's value? And where's overvalue? Where's something undervalued and where's something overvalued? Well, overvalue, we can pretty much clearly see any new high is being flushed. Any new high being flushed. New high being flushed. Overvalued, right? Where's undervalued though? I mean, is it here? Is it here? Is it, was it here? Was it here? It's too hard to tell, because you have these big flushes that are coming into the market, right? By the way, this is implied volatility, and this is the ATR, just to give me an idea of, what to expect. So right now we have basically probably one of the most, excuse my language, effed up markets that I've seen in my entire, 40 years of trading. Because it's not a bear market. It's not even really a bull market. It's a psychotic bull market. It's a crazy bull market, right? Like I guess you could say there's classifications of bear markets. There's classifications of bull markets. This is a psycho bull market. This bull is just running all over the place. Nobody knows where it's going to stop or turn or move or anything like that. And it's creating absolute chaos. And I will be honest with you, during 2018, I lost money that year. It was a bad year for me. I did okay. I did okay. I lost money in 2017 for the first part, but near the end, I started to get my shit together, and I was able to make it all back. But then I lost money in 2018. I was down net about 21%. It's taken me this long to figure out this is just craziness, right? And for any of you that are in my room right now, um, and you're following me here, you can see this has been a hard fought 55% return, right? I've had to go and actually trade penny stocks in some cases because it's just too crazy to find, is it going up, is it down? I want to call this the tweeter market. I don't even call it the Trump market. I'm going to call it the tweet market. And here we are today, again, putting in another solid day in spite of all this terrible data. Now, I don't think the market's going to go too much higher. I think I think this little balance area in here, we're testing this point of control, and I think we're probably going to go drop back down to the 282.21 area. I would actually love for us to spike up to 303.24 because I would love to fade that with this backdrop. Okay, I think that would be a beautiful fade, and I think that with the data that's out there, it would be a crazy thing. So, in my room, this is a very long-winded education, as well as why I've been having trouble calling trades in my room for you guys, because because of this psycho bull that we're in, and it's like it changes 1 minute to the next, right? It really does. If you don't like the market today, wait a week, it'll do the exact opposite. If you don't like it in a week, wait another week and it'll do the exact opposite. There's no follow through, right? There's no consistency. And that is just part of the psychosis of this market. So that being said, what I'm going to start doing in my floor trader room is I'm going to start taking advantage of this psychosis. And, that's what I've had to do as a great trader I don't even know if I would call I call myself a great trader. You might not think I'm a great trader. But as a great trader, you want to be adaptable. And being adaptable means altering your game plan that to match market conditions. So how did I alter my game plan recently? Well, I started shorting stocks and buying calls. Right? I just started doing that, and I'm going to keep doing that. So what I'm going to do is either one of three things, and just pay close attention here. The future of this room, the future of my room, to take advantage of this, I'm going to call it if I can never learn how to spell, psychotic. Good Lord help me. By the way, people, I am dyslexic. Please do not hold that against me. I actually have reading and writing disabilities. Psychotic bull market. The future of my room to take advantage of the psychotic bull market is threefold. Okay? One, short the stocks I like, and buy calls. Okay, so the plan with that is, let's say, for example, which I am kind of bearish right now on Caterpillar. I just took a Caterpillar short here, so just to give you an example of that. Daily, one day. Let's look at CAT. I just took a trade this morning on it. So I'm shorting this Caterpillar right here. I may add to the trade. So what I'll do is I'll short the stock, and I'll buy calls, right? Short-term calls, like 9 days, right? 9 days or less. And that way, if it spikes up before it goes back down, I can cover my calls and then get out. I did that trade very similar. I did that trade on T recently. I should have held my calls. But what I did was after this, it wasn't T, sorry. It was, shoot. It was recently just did the trade on, wasn't T, it was one of my other trades. I apologize, I should be more organized for this thing. It was, what the heck was it? Hold on a second. Let's take a look. It was BAC, AMD, no, CAD, no. Disney, 1 second, guys, forgive me. HD. Target, forgive me. Okay, so Target, what I did was, after these earnings, I wanted to short this on a smaller time frame. And what I actually did was I short the stock at 105. I believe it was here. And I bought calls. So I short 105 and I bought calls. And then what happened, it spiked all the way up to 109. I covered my calls and then I got out of my short as well too for a small profit. So that's an example of what I'm going to be doing going forward with the room. That's one example. The second example is what I'm going to be doing is I'm going to be doing a calendar. Okay, a calendar spread. A calendar spread. So what a calendar does, if you want to look it up, but a calendar basically, I'm going to be, if let's say that I am interested in shorting Target right now. So just go back to Target here. No, Target, sorry. Go back to Caterpillar. So Caterpillar. So let's say I want to short this. So what I'm going to do is I'm going to buy the longer term put. In other words, I bought the 124s here, and those are 2 weeks away. But to reduce my risk, I sold the 120, the exact same 124s, but I sold the week before. So instead of paying, like, let's just say $1 for the Caterpillar put, I only paid 50 cents, right? And that reduces my risk. So I might be right on a trade. It might pop up, I reduce my risk, and then a week later, it'll be back down. So that's going to be my other strategy that I'm going to be doing in the room. And and the third thing that I'm going to be doing is I'm going to be buying out of the money puts and calls. Okay? Now, I call these trades my lottery trades. So the reason they're called lottery trades is because you set them and you forget about them. So in other words, I might, let's say I'm short, I like Caterpillar short, right? As it sells off today. I might do like a 127 call and a 119 put. So I'm long and short, all right? But they're far out of the money and they're really cheap. And why was that good? Because if we get the continued psychotic bull market like we're getting, and the market spikes around, spikes up, spikes down, I can, when I get to levels that I like, I can take one side off and let the other side run, right? Or if the market just moves strong in one direction, like Caterpillar, Forgive me. Um, I'm so sorry, people. Caterpillar, I'm expecting to go down here, 111, once this market rolls over. So if my puts and calls cost me a total of $1, that could be a big trade. But in the meantime, if we get a psychotic spike up, I can cover it. Okay? So that's the trades that I'm going to be doing both in my personal account. So look for more of these. Okay? So I hope you guys enjoyed this video. Remember to like and share this video with people. I don't know what the heck is going on. You know, I surf around YouTube and I see other people that are making trading videos and I go, this is just such crap shit out there. Again, forgive my language. And, you know, these people have like, you know, thousands of subscribers following them and it's complete garbage. And, you know, I got like 1,000 people following me on YouTube. I mean, it's great in this stock Twitch room. I got 2,400 members right now, and thank you all, love you all. And thank you for supporting me. But I have no idea why my YouTube channel and both my Twitter account don't do well either, right? Now remember why I'm doing this, guys. I'm doing this because, number one, I want to help you make money. Number two, I want you to buy my course, right? I'm not going to lie. I make money and subsidize my income from, you know, selling my course, right? And it is by far one of the best educations that you can get on the market. I know it's really expensive. I know there's other stuff out there that is a lot cheaper, right? But I promise you, these testimonials are right. They're all honest, real testimonials from real people. You can actually, if you don't believe me, I'll let you even talk to these people, right? Go through my testimonials. I'm the real deal, okay? I'm not like these other people. Now, you know, am I fancy? Do I have, you know, 1,000% years with penny stocks? No, but I am effing consistent, right? And I've made millions of dollars from the markets over years and years. Do I make money every year? No, but I make money 8 out of 10 years, and I promise you nobody else will do that. These other people that are out there teaching you right now, they might have 2, 3 years, 4 years that are good. But again, markets change, and the markets will change again, but they won't be around. But I will. I was here, you know, 40 years ago, and I'm going to be here 40 years, hopefully. Maybe not. Maybe. Yeah, I could be here 40 years in the future. Anyways, thank you all for watching. Remember to like my video. Remember, buy my course if you're serious about having a long career in trading, right? Don't go for these people that are flash in the pan, one-hit wonders that are trading some pattern. There's no magic pattern. You have to understand everything, how markets work, the way they work, how to adapt to it, how to use. I have the best money management system in the world. Right? Why do I have the best money management system in the world? Well, because I've lost a lot of money learning how to do it. Anyways, thank you again. Love you all. Bye for now.